Yesterday, shares of the Gap Incorporated fell sharply. The stock dropped about 14.41% on Friday, March 6, 2026, after the company released its latest earnings report and forward guidance. While the quarterly results themselves were roughly in line with expectations, investors reacted negatively to weaker guidance, margin pressure from tariffs, and continued weakness in one of the company's major brands, Athleta. In this video, we'll break down exactly why the stock dropped so much, what the company actually does, how the business has performed in recent years, what analysts are saying now, and whether the stock might actually be undervalued after the sell-off. First, let's briefly understand the company itself. The Gap Incorporated is one of the largest apparel retailers in the United States. The company designs, markets, and sells clothing, accessories, and personal care products through both physical stores and online channels. Its portfolio includes several well-known brands. Gap, which focuses on casual American-style apparel. Old Navy, the company's largest brand, known for affordable family clothing. Banana Republic, which targets a more premium and professional clothing segment. Athleta, which focuses on women's activewear and athletic lifestyle apparel. Together, these brands generate billions of dollars in annual revenue and operate thousands of stores globally. Now, let's talk about why the stock dropped so sharply last Friday. The biggest issue was weak forward guidance. For the first quarter of fiscal 2026, Gap projected revenue of about $3.51 billion. That came in slightly below Wall Street expectations of roughly $3.53 billion. Another major concern was margin pressure caused by tariffs. Management warned that import tariffs will reduce first-quarter gross margins by about 200 basis points. In retail, a 200 basis point decline in margins can significantly impact profitability. Operational disruptions also played a role. A severe winter storm in January forced roughly 800 temporary store closures across the company's retail network, reducing sales during an important part of the quarter. But perhaps the most concerning issue for investors is the ongoing weakness in the Athleta brand. Athleta reported a 10% decline in comparable sales in the fourth quarter. The brand has struggled to maintain a clear identity in a competitive activewear market with newer entrants like Alo Yoga and Vori. CEO Richard Dickson acknowledged that Athleta had become too bland and lacked a distinctive product direction. To address this, the company appointed Maggie Gager, a former Nike executive, to lead the brand's turnaround. Her strategy focuses on redesigning product assortments to better match consumer preferences and restore Athleta's relevance in the activewear category. However, management warned that recovery will take time. Comparable sales at Athleta are expected to continue declining at a mid to high single-digit rate through the first half of fiscal 2026. Now let's zoom out and look at the company's stock performance. Over the past year, before Friday's drop, Gap stock had delivered a return of about 23.2%, beating the S&P 500's roughly 17.4% gain. Looking at the past 3 years, the stock has surged more than 113% as investors responded to the company's turnaround strategy under CEO Richard Dickson. However, the longer-term picture is less impressive. Over the past 5 years, Gap stock has produced a total return of about 3.4%, far behind the S&P 500's roughly 75% return. So despite the recent rally, the company is still recovering from years of underperformance. Now, let's look at what analysts are saying after the sell-off. Most Wall Street analysts remain cautiously optimistic. The current average price target for Gap stock is about $30.73. Based on the recent trading price of around $23.28, that suggests a potential upside of roughly 30%. Price targets vary widely. The lowest estimate is about $22.60, while the most bullish target is as high as $41. For example, J.P. Morgan recently lowered its price target from $36 to $33, but maintained an overweight rating, saying the company is entering phase 2 of its transformation strategy. Now, let's discuss valuation. From a value investing perspective, the stock looks relatively cheap compared with its historical levels. Gap currently trades at a trailing price-to-earnings ratio between roughly 10.8 and 12 times earnings. That is far lower than its 5-year average P/E of about 25.5 and its 3-year average of roughly 22.6. In other words, investors today are paying about half the historical valuation multiple. The dividend yield is also attractive. Gap currently offers a dividend yield of about 3%. Management recently increased the dividend by about 6% and also authorized a $1 billion share buyback program. Another positive factor is the balance sheet. Gap holds roughly $2.6 to $3 billion in cash, giving the company strong financial flexibility. If we look at forward earnings expectations, analysts estimate the company could generate around $2.20 to $2.35 in earnings per share for fiscal 2026. At the current share price, that means the stock is trading at roughly 10 times forward earnings. However, there are still risks investors should watch. Tariffs have become one of the largest sources of margin pressure across the retail industry. In the fourth quarter of 2025, tariffs reduced Gap's gross and operating margins by about 200 basis points. The company expects a similar 200 basis point hit to gross margins in the first quarter of 2026. To reduce this risk, Gap has been diversifying its supply chain. China now represents less than 3% of the company's sourcing, down from about 10% in 2024. The company also plans to ensure that no single country accounts for more than 25% of its sourcing by the end of 2026. Gap also plans to increase the use of American-grown cotton, selectively raise retail prices, and improve logistics efficiency to offset tariff costs. So, what's my personal view? In my opinion, the market reaction last Friday may have been somewhat exaggerated. Yes, tariffs and Athleta's struggles are real challenges, but the core turnaround story still appears intact. With the stock trading around 10 times forward earnings, a 3% dividend yield, and strong cash reserves, the valuation does provide a margin of safety for long-term investors. If the company can stabilize Athleta and continue improving brands like Old Navy and Banana Republic, the stock could gradually recover. Thank you so much for watching this video. If you found this breakdown helpful, please consider liking the video and subscribing to the channel for more analysis on stocks, investing, and market insights. And I'll see you in the next video.